CBRE guys, take your guests, sit down, let's start. Let's sit down, please. All right. All right. Sorry. The voice level, please take this a little bit down. I'm cautious of time because we've got more guests also, but online. So all the people who are watching us in front of the computers, welcome as well. Ladies and gentlemen, very warm welcome from all of us, dear friends, dear business partners. We're happy that you came here to not only visit and listen to us, but also share your experience and your thoughts on investment market in Poland, but also in the wider context in CE and EMEA, if possible. First of all, I would like to tell you that there are two emergency exits. At CBRE, we would like to say that we would like to be safe and also your investments. So one is at the back, the other is at front when you entered. I would like to say a big thank you to all the organizers from CBRE, from our partners, from all of you who put a piece in this event to make it happen. Thank you very much. A little bit of housekeeping. We're starting now at 10. We should be finished around 2, which is from 1 to 2. There's going to be a lunch. We're going to have one coffee break, which will be about 1:45, 1:30, depending how with the time. And definitely there'll be a time for networking, which we all love a lot. I would like to, besides dear guests, I would like to also welcome our speakers. Jos Tromp, Head of EMEA Research, will tell us about the wider context of investment market globally and EMEA, and maybe a little focus on CE as well. Sean Doyle, Head of Investment Properties Poland, will tell us about what is happening actually in Poland and why you should invest more money in this country. Marta Abratowska-Janiec and Vidi Tank, both from CBRE, they will tell about hotel market, which I think is very hot at the moment, and we shall look at this as well. And Paweł Dębowski from Dentons will tell us the lawyer's perspective. And I know Paweł has really great and strong opinions, and definitely we'll be able to learn from him a lot. We will also have a panel discussion. Jeroen van der Tullen, Managing Director, CE Ghelamco. Matthias Broderser, Head of Transaction Management, Warburg HIH, Liad Barzilai, CEO, Atrium Europe, and Antony Selman, Head of CE Investment, CBRE, and also Robert Dobrzycki, CEO, Europe Panattoni, will tell us how they see investment market in Poland. And I promise you that I will grill them a lot, asking very tough questions. But of course, you can always ask questions as well. It's a very open, open event. Short recap what happened last year. A year ago here we were sitting with a little bit long faces. Everybody was talking about political situation, instability, what is happening, you know, big development pipeline, uncertainty, and so on and so forth. Nobody knew what's going to happen. But the market showed resiliency with the 4.7 billion of investment volume in Poland. It's actually proved that this market is stable. Some people are saying it's already matured. I think it's maturing. It's like a development process and it will take some time. But anyway, the politicians didn't spoil our business. But frankly speaking, the last year was like a roller coaster. Every 3 months there was something happening. There were decreasing of rating of Poland. But now situation is much better. Is it going to be a joke? I think the very good thing happened that our foreign affairs minister made a deal with San Escobar. For those who don't know the situation, please explain your colleagues from the other countries. And from that deal, we have a strong ally in the South America. From that day, the situation is improving. So we're seeing better ratings of Poland. The forecasts for economy are getting better. The VAT, which was a big case last year, is being paid back. Not, you know, we can say that it's a clear situation, but there are strong cases that those taxes are being paid. And I'm sure some of you can share your stories with your colleagues from other companies how to make that happen. Retail office still strong and strong interest from the investment companies. Logistics will follow, definitely. There are strong cases now that you know, the occupational market is getting stronger, especially on the logistics side. Most probably this will be caused by post-Brexit situation. I've heard in the news that Nestle is opening the factory in Poland. They're moving jobs from UK to Poland, actually. So it's a good side. Of course, there's a big development pipeline on the office side, but I think also there is strong occupational market from organic growth of the companies which are already present here, but also we may face a situation that post-Brexit, you know, the companies will come to Poland, and there are definitely two big cases actually in Warsaw. Big banks are looking for a space in a magnitude of 15 to 50,000 square meters. So it's something to be considered as well. Also, the REIT legislation will be in force this year, which will help the investment market as well, and to accumulate the local capital. It's from our perspective, it's a good news because finally there'll be instruments to accumulate local capital, and more investment will follow. So. Overall, I would say the situation is improving. Of course, there are some threats which will be most probably revealed during the discussions today. But I wish you pleasant time here with us. I hope you'll learn a lot, but also share your knowledge, because this is how we make this market going on. Thank you very much for coming. And I would like to introduce our first speaker, Jos Tromp, Head of EMEA Research, CBRE.
Thank you, Daniel. I would definitely agree with Daniel that there's a lot of positive news to be told. I think we're coming from an environment where we had particularly on the political side, a lot of stability for several years in Europe. But that situation has started to change. Obviously, we had 2016 with two very particular events taking place. Like this, I think this is better. Two particular events taking place. One obviously focused on the UK, and the other one focused on the US. And I think that was just the start of it. 2016 was a very turbulent year, but if you're actually looking at the performance of the investment market, the situation was very, very strong. So if we're having a look back into 2016 in terms of what's happened and what kind of impact the UK Brexit vote had, it caused a lot of uncertainty, particularly in the UK. There's a lot of discussion going on at the moment on political level to really see what kind of impact this is going to have in terms of trade with Europe, migration, all kinds of things. But the true impact in terms of real estate impact was visible, particularly in the UK, not really on the continent. And I will get back to that in a second. So a lot of uncertainty caused by that event. But if we're looking at the situation in the US, actually, the Trump election brought a lot of clarity. A lot of clarity for real estate, a lot of stimulus for the economy there in the real estate markets. So there's an example there of negatively affecting the property markets. There's also an event up there of positively influencing the markets. And linking that to the situation that we're going to see in 2017, it can go all directions. We had elections in the Netherlands, and they panned out from a property perspective quite well, I would say. A very strong populist movement visible there as well, but ultimately center-right is probably going to win the elections. Coalition forming is happening at the moment. And the first round of elections in France is pointing towards a similar trend. Elections coming up in Germany later on in the year, and an event that I didn't have in last week yet is a newly planned election in June for the UK again. Probably not really going to change the direction of politics there. We're probably going to reconfirm, let's say, the path that we're on. So all in all, a lot of uncertainty, but as said, if we're looking at the property markets, the property investment markets, there's not really a lot of change. The lines are pointing clearly upwards. But financial markets are looking at it slightly differently. So what I've done here, I listed the Euro Stoxx 50 index, so including an index of the 50 largest listed stocks in Europe. And this is that trend. Very good news, economy is recovering, performance of business is pretty good. And if I would extend this chart back, you will clearly see that the peak that we're currently facing is by far not the peak that we've seen in the past. So European stocks are relatively cheap. That's a different situation in the US. The US stocks are relatively expensive. However, if we're putting the hedging costs in, without becoming too technical, these are the hedging costs for that same stocks index. You clearly see a very stark spike in 2016 June around Brexit, and a similar spike towards or in the run-up to the elections in France. So despite the fact that property markets are turning very well, trading is very strong, the actual wider financial markets are pricing in the risk that they are seeing in politics. So I think that is really important to keep an eye on. I don't know how many of you have been at MIPIM, but I felt giving a very brief summary of the results out of our European and global investor intention survey would help setting the scene for the day. So we'll show a very short video to highlight, let's say, what the view from the property industry in terms of the sentiment that we're facing for 2017. It's going to take slightly over 2 minutes. without sound, it's far less interesting than just continuing. We might try to put it back on a bit later on, but the story was, in principle, there is a very strong appetite for investing in real estate, whether we're looking at that globally or European. A very strong interest in the office segment and in logistics, and that retail interest is slightly lower. And that is obviously caused by the changes that are happening in the retail industry, e-commerce affecting the chain, and actually logistics at the moment is benefiting from all of that and putting retail a bit under pressure. So that in summary, there's a lot of capital to be invested. However, we're starting to see that raising capital is starting to get more complex. So a lot of capital available, actually more than last year, and that is putting yields under substantial pressure. But newly raised fresh capital is more difficult to find. And if we're looking at the performance of the actual investment market in Europe headline, you would say, okay, things are starting to turn. So these are trailing 4 quarters, so rolling 4 quarters for Europe as a whole, including the UK. Still, I would say the performance is really good. However, if we're taking out the UK, this is the story for continental Europe. Very, very strong growth. So if we're taking out the UK, and actually the UK is the only market that is showing a decline, the market is really booming. So a lot of capital volumes are proving this. Strong capital markets at the moment. And highlighting that fact again on the UK, the blue line is the UK, a very strong decline visible there. And for the first quarter, we didn't really see a change to that. So comparing Q1 for the UK to Q1 last year, there was roughly a drop of 15%. This is all in euros, by the way. The good news is Germany is doing really, really well. Germany, comparing the first quarter to last year's first quarter, was up by 50%, whilst we thought that product shortage would keep the volumes relatively restricted. So very, very strong conditions in Germany, and the interest in France is also staying on a very, very high level, despite the fact that the elections were planned for, and we're facing the second round. So strong performance there. And focusing in on the top line for CEE, again, the 4-quarter trailing totals, also there, very, very strong performance. Whilst we saw a very lagging effect initially after the financial crisis in Central and Eastern Europe, cross-border capital was hesitant to move into Central and Eastern Europe again. We're now seeing that the yield pressures and the amount of capital out there is really pushing up volumes again and putting a pressure on yields again. But obviously, this is nothing new for you. Politics, how important are they? I already mentioned and referred to the UK. The event Brexit had a very big impact on volumes and also actually leasing volumes, so investment volumes and leasing volumes in the UK. But how important are these political events globally? What I've done here, I highlighted the G7, so the largest 7 economies, and then the unemployment rate over time since 1980. So roughly 30, 40 years of history on the unemployment side. So you can divide it in roughly 4 cycles. We're quite far in that cycle today. We're facing a low unemployment rate of around, let's say, 5-6% for these large economies globally. And what I've also done, I plotted some of the major geopolitical events over time in there. And a couple of examples are the US invasion in Iraq, early 2000s, the war starting in Syria in 2012, and of course the Brexit vote in June 2016. And the point that I would like to make here, these individual political and geopolitical events are of course important for the country where they are taking place, but they are typically not changing the dynamics of the cycle. And that, I think, is really important to keep an eye on. So what is important? The economic fundamentals, the property market fundamentals, and the financial market fundamentals. So firstly, having a look at the economic fundamentals. Globally, they look pretty bright, more or less in line with what we've seen last year, no true big changes, and also in line with the last year 5-year averages. So growth is solid, it can be better, but it's good enough. Looking at the individual regions, Asia Pacific, doing pretty good. Last year we were a bit concerned that Chinese growth would be too low, but actually it's above target at the moment. So that's going pretty well. In Japan, growth rates are growing as well, so big economies in Asia are growing. The only issue there is it's a lot of borrowed money. So that's building some pressures on the economy midterm. But things at the moment look pretty good, important for the world economy. So foreign debt is a midterm risk. The other point that I would like to mention in terms of capital flows is outbound capital from Asia. We've been speaking about that for years, but we're now really starting to see a growing appetite of Asian investors buying large-scale properties or platforms in Europe. And this is really, really important because those investors are really the ones who are really chasing the low-yielding properties. And that is what we're seeing across most of the gateway cities, but we're starting to see that now in Central and Eastern Europe as well. In terms of the US, as I already mentioned, the elections in the US brought a lot of clarity. There's a strong belief in the US at the moment that the economy is going to perform this year and the next years to come very solidly. But short-term performance is a bit lower. That's why I put a question mark up there. There's a strong stimulus going on. What the government is trying to do is bring taxation down, which is going to stimulate companies and consumers who are going to invest in the economy. They're also going to invest a lot in infrastructure. So that is going to stimulate the economy as the expectation. And what is that causing? That is causing the private equity that targeted Europe over the last couple of years very, very actively is probably going to bring that capital back to the US, at least to some extent. And that is explaining why some of the platforms at the moment are being sold. Some of the big ticket assets that they've bought 2-3 years ago are being sold. They simply achieved their business plans. Part of that money is going back, particularly the money that was invested in offices is going back to the US to invest there. And some is also going into retail now very actively. That is a trend that we're seeing coming through now. They're really seeing an opportunity in retail despite the fact of the challenges that I mentioned earlier on. If we're looking at Europe, the situation is getting better. So even though we have a lot of political issues around in Europe, the situation is clearly getting better and the capital is seeing that. So the growth is spreading. The labor markets are up, and the peripheral issues that we've seen particularly in France, in Southern Europe, are starting to become better now. Youth unemployment is a serious issue still in Southern Europe, and that might affect, let's say, the growth midterm. But at the moment, the situation is getting better, and capital is seeing that and investing in Europe very actively on the back of that. A slight issue we're seeing, and that is related to the point that I tried to make on US capital going back to the US. The question is, who is going to replace that in Europe? Our expectation at the moment is that institutional capital will fill that in, combination of European capital and particularly Asian capital. And the first evidence of that we've seen now happening. So all in all, the situation on the economic fundamental side is pretty solid. And politics are, of course, important, as I said, but are not going to affect the cycle, is our expectation. But what's truly important to watch in 2017 are the bankers. Firstly, the Fed. The Fed obviously started to change policy towards the end of last year already by bringing up interest rates in the US. And the expectation is, despite the fact that the short-term growth rates were a bit disappointing, that towards the end of this year we're going to see another 2 or 3 spikes or hikes in interest rates in the US. And that is really important. The other thing is obviously the European bankers. The ECB is a bit more restricted in terms of what it can do short-term. There were expectations earlier on, a couple of years back, that interest rates would move up more quickly in Europe. But due to disappointing growth, they needed to keep on buying bonds. So the bond buying purchase program that is currently in place, measuring around 60 billion a month still, needs to be brought back to zero before interest rates can move up in the Eurozone. And that is important because before that, it can't change. So therefore, the expectation is that the interest rates will only start rising starting early 2018. And there was a lot of speculation and discussion about, let's say, the measures that Trump was applying. But at the moment, it seems that the impact of that are going to be milder than expected. So therefore, we feel we need to be focused on the central bankers and not necessarily on politicians to understand where the market is heading. So just summarizing briefly where we are. Said economic growth is coming through, it's widening, it's improving, which is in principle good for the fundamentals of the real estate market. But we're also starting to see that pressures are building because of the fact that there's so much capital in the markets, whether we're looking at residential markets or commercial markets, inflation is slowly but surely going up. So that needs to be curbed ultimately. Which brings us to the caution. And several of you, many of you have worked with in the past, will have seen something similar. These are the 10-year government bond yields. It's an average for the Eurozone area, so a bit of an artificial average. And the top line is for the same area, the prime office yields. And the gap between these two lines indicates how interesting it is from an institutional investor's point of view to go into real estate. The gap between these current two lines here is still historically big. So despite the fact that yields are, again, for the biggest 7 countries worldwide, and the point that we're reaching here now is getting close to 5%, similar to the situation in 2007. And if you look at the top line, so the dark green line, that's the European office vacancy, and that's just starting to trend down. This is a trend of the last, let's say, 12 to 18 months. So it took a very long time before the office market started reacting to the change in unemployment. So that's finally good news. And that's starting to feed through in terms of rental growth. And these are actual rental growth rates. This is not a forecast or a projection that we have. And even to me, it was a bit surprising. We have some markets where we're still seeing negative rental growth. Unfortunately, Warsaw is still amongst those. Marginal, but still. But more and more markets, particularly in Western Europe, are starting to see very solid upticks in rental rates now. Up to Stockholm, Amsterdam, where we're seeing clearly above 10% year on year, and the pace is increasing. And it's driven by the fact that occupational markets are very healthy. Vacancy is going down. There's limited development. Typically, governments in the office sector are very, very hesitant to build or to allow building. So that's stimulating rental rates to go up. And particularly in the light of the whole Brexit discussion, this is a very interesting feature because ultimately, if companies would decide to move somewhere, they would need to be able to find space. And I think this is quite a critical element in the whole decision-making process. So good news on the rental growth side. And this is also highlighted in one of the global pieces that we recently put out, and it's confirming the same cities as I put on, so Stockholm, Berlin, but also in particular the smaller markets. So out of the 10 fastest growing cities in terms of rental growth for offices worldwide, 6 are located in Europe. And out of these 6, it's a mix of smaller places and larger places. So it's becoming a wider phenomenon, which is again good news for capital values. And it's not only offices, we're starting to see similar trends in logistics as well. So vacancy across Europe, and this is then for the tier 1 markets as we call it, is clearly on a downward trend in logistics as well. Moving down from around 7% in 2009 to around 5.5–6% today. The rental growth that we're seeing in the office sector is not clearly visible in the logistics sector yet, particularly for new build. But for these extensions, we're starting to see some upward rental growth there as well. So value add is becoming increasingly attractive due to the fact that product shortages in prime is pushing investors to the secondary or the value add segments. And whether or not we should really call that secondary, I don't know, because of the uptick in occupational market performance. So it's changing across the board. We spoke about politics. We've spoken about outbound and inbound capital. 2 sources to watch in particular. Asian capital moving in, a big source of capital and growing very, very quickly, paying very sharp yields. And private equity capital from the US partially moving back. Logistics, really hot, very low yields. The market is performing well, but there the building time, the response is obviously a lot shorter than offices, so therefore, a bit different dynamics, but there's a bit of rental growth starting to come through there as well. And you can clearly see, and that was one thing I wanted to highlight in the survey, but didn't come through, is focus from the yield perspective to the occupier. So there's really a focus now on the occupational market performance, and there's really going to drive capital values going forward. Thank you.
Jos, thank you very much. It's really great perspective, and I think, as I speak about CBRE in Poland, we're still going to invest in people and the labor force, because there'll be more investments and more assets for us to advise for you, to transact and manage. And now we're switching to pure Poland perspective. Sean Doyle will give us presentation and his thoughts on where to invest and why to invest in Poland. Sean.
Hello, is it working? Okay, we seem to have a little bit of another technical issue, but hopefully it'll sort itself out in a second. For those of you who don't know me, I'm Sean Doyle, Head of Capital Markets. I'm going to talk to you about the investment market. Can we pause it for just a second? Sorry, can we just pause it quickly before we start? So I'm going to talk to you about the investment and occupational market. I've tried to fit quite a bit in here, but also leave some time at the end, just in case if anybody massively disagrees with anything I say. Obviously, I'm, as your friendly local broker, I'm ever the optimist when it comes to the Polish market. So, but if anyone does have any questions or wants to challenge me on any of the things I say in this presentation, there'll be time at the end. For those of you who do know me, you've probably sat through some of these presentations before, and those of you who don't, I narrated a bit like David Attenborough, so forgive me for any mumblings. Okay, press play. So last year we saw a record post-crisis 4.7 billion investment volume in Poland. And that was in spite of the political issues that we mentioned earlier, some of which impacted the market. Obviously, the key one from 2016 was the issue of the uncertainty over the recoverability of VAT. This one obviously affected a number of investors, and it remains an issue, but it does look like there's clarity coming from the tax authorities. And now many investors are opting for the share or enterprise deals. Most other legislation, however, did not affect the real estate market. The one piece that is being proposed by the government and is still up in the air is the potential of Sunday trading ban on retail. But it remains unclear as to whether or not this will move ahead. Last year it derailed or delayed a couple of certain transactions. But the office market in particular, the office investment market, remained particularly resilient. We saw around 1.8 billion euros worth of transactions last year, which was again another post-crisis record. The largest deal of the year with Q22 from Echo, and then HB Reeves' Gdański Business Court in the north of the city. And there will be larger to come in 2017, hopefully. Such as the iconic Warsaw Spire, which was recently awarded the MIPIM Award for the best office development. But the occupational concerns, we feel, the other major issue, we think they're largely misunderstood. Investors do need to focus on headline versus effective rents. But the concern over the office pipeline and oversupply, in our opinion, is slightly exaggerated and needs to be placed into context. It ignores the staggering net absorption figures we see. Increasing city centre demand at the expense of non-central locations as well is another major factor, and the large investment bank requirements following Brexit that are in the market. There's around 4 of them and counting. And many of these are focused on the Western city centre. And the success of the Western city centre has been proven with the leasing of the Warsaw Spire. And then as you move into the city centre, this net absorption totaled 270,000 square metres for the last 2 years. But then we have a relatively modest pipeline as well for 2017 and 18, with just over 200,000 square metres to be delivered before 2019. And most of this, is already pre-leased with things like Citibank and Generation Park. Subsequently, we're already seeing a fall in city centre vacancy. It's fallen from 15% down to 13%, where it was in mid-2015. And headline rental levels and incentive packages have now stabilized. Currently, prime rents are in the low 20s for prime space and going up to the mid-20s in the towers. But in the midterm, up until 2019, we believe we could see some growth in these levels as Grade A space fully gets leased. But at least until mid-2019, when we will see the significant pipeline be delivered. And this visualization sort of demonstrates much of what is happening in the Western city centre. But the large requirements in the market, some of these new 50,000 square metre requirements, will fill much of the tower development that is happening. An important point to remember as well is that approximately 50% of Warsaw office stock is B class. And much of these buildings are now becoming structurally vacant. These buildings from the late 90s, early 2000s. This is exactly where vacancy is rising the fastest. And these buildings are really suffering when they compete with some of the A-class existing city centre buildings. And in particular, they struggle to, they will not compete with the new build, which is largely getting pre-let prior to completion. Importantly, Warsaw's take-up comes from a variety of sectors. We're not heavily reliant on the BPO sector like many cities in the region. Financial services, advisory, and in particular tech companies are a major part of the growth, while Warsaw is listed as one of Europe's startup hubs. Importantly as well, the public sector demand growth has been significant. It has doubled every single year over the last 5 years, culminating in around 130,000 square metres last year, as this sector as well seeks modern office solutions. An estimated 1.5 million square metres is expected to come from this sector over the next 6 years. Given the market dynamics, we believe we're at the bottom of the rental cycle, or close to it. We're 30 to 40% down from where we were at the peak. Prime yields at around 5% gives capital value ranges in the city centre prime buildings between 4,600 to 5,000. With regards to Mokotów, there's still 1.3 million square metres of space. Historically, it was the most active market in the city, but negative net absorption rates last year, which has been made worse by the infrastructure works on Marynarska. And tenant frustration at travel times and lack of amenities is one of the major problems in the market. Still, there is 135,000 square metres under construction. However, once the infrastructure is complete, some of the frontline schemes, particularly on Marynarska and on Wawowska, those that give good access to the trams, and buildings like the new Postępu 14, which will have numerous access points from the different streets and are continuing to lease. These are the buildings within Mokotów that will do well. Rents, we place anywhere between 13 to 14 euros. And with yields at 7% plus, this is a significant discount on city centre capital values. Older buildings are trading at sort of 1,500 euros a square metre. So in Warsaw, what is worth investing in? As I mentioned, and you can challenge me later, I believe we're close to the bottom of the rental cycle. Buying core CBD at capital values of up to 5,000 euros a square metre is a good buy when you put it in a European context. And then B-class office, the potential for conversions as well is something I'll touch upon later. But already there are a number of value-add opportunistic investors looking at this. With regards to regional market, Krakow was obviously the first one to speak about, Poland's second city. The number one tourist destination in the country, but importantly, a global leader in terms of BPO destinations, and this shows no signs of abating. It's expected to continue in the coming years. Total stock of around 950,000 square metres, despite the fact there was 150,000 square metres delivery last year, vacancy still fell down to 6.5%. However, there is 300,000 square metres under construction today in Krakow, which could see that rise. Today we see prime yields at around 6%. Secondary or B class is priced again this 200 basis points gap at around 8%. And some of the very best business parks in the country, such as Quattro Business Park, and some of the others we showed on the screen just there, will trade at around potentially low to mid sixes. The Wrocław office market is one of the best performing office markets in the country. 870,000 square meters of stock and 150,000 under construction, net absorption of 90,000 square meters. So very close to Krakow's figures. And this saw vacancy fall from 12.5% down to 10% in the Wrocław market. Most of the vacancy in Wrocław, however, is in non-city centre locations. So with the continued strong demand we're seeing in Wrocław, we do expect vacancy to fall. And Q1 net absorption was already at 40,000 square meters. So that's a huge number for a first quarter, higher than Krakow. Prime buildings like Green Day, Pegaz, we expect these to trade at around 6%. And Wrocław may be the first market that sees it go below 6%. Rents are marginally higher than Krakow, but due to the strong occupational story we are seeing across the country, this is repeated in other markets as well. Gdańsk in particular is seeing a huge growth in demand. There was only 12,000 square meters delivered to the market last year, and against a net absorption of 90,000 square meters, it's made for a good figure last year. So vacancy fell down to 10%, I believe. Elsewhere, vacancy rates continue to fall due to the high level of new entrants into the market. When you look across the regional markets, 370,000 of the 550,000 square meters of take-up is net absorption. So when looking at the regional markets, what should you buy? When you look at a number of Wrocław, Krakow, it's very difficult to secure city centre because of the historical nature of these cities. However, in the core sort of internal ring roads or secondary ring roads, there are a number of key office parks, business parks, which do offer good opportunities. It's okay. With regards to logistics, we saw record volume last year, 760 million. Larger portfolios were responsible for a lot of this, and the growth of e-commerce, things like Amazon, are likely to boost this even further in the coming years. So we saw record logistics take-up, and net absorption was around 3.5 million square meters of take-up, and over 1 million square meters for the third year in succession of net absorption, which is unrivaled anywhere. We're seeing record low vacancies across the markets, but rents are stable. Even with these low vacancies, rents are not really showing any signs of growing at the moment. That may change. We have seen a return of spec development. The new motorway network has created new locations, and with the new express node network being extended, this will continue. There is investor concern over headline versus effective rents, and that has created a couple of liquidity issues on some assets. Thus, investors are seeking longer leased assets, and developers are responding to this by creating these products. Particularly, investors are looking now at portfolios that they deem to be lower rented, or longer lease logistics can trade in the low fives, and portfolios with a sustainable rent will trade close to 7 or just sub 7%. Capital values can range from 500 to 700 euros a square meter, depending on the bespoke nature of the tenant improvement or the fit out. So what should investors focus on? Well, I pretty much said it there. I mean, depending on the cost of capital, the growth of e-commerce tenants signing very long leases, anywhere from 12 to 15 years, is growing. And irrespective of rents, buying off of these yields, off of 7% yields, you're still buying at a discount. And investors should also consider light production and manufacturing. The higher fit out means tenants are less likely to leave. And I think most importantly, investors should start thinking beyond the 5 core locations. The logistics market has extended down into the smaller cities, as many tenants are focusing on the labour. The retail market witnessed almost 2 billion euros of investment, and we expect even greater for 2017. This will be largely due to the large portfolio trades which are happening and a number of large prime shopping centres. However, the occupational market here too is not without its challenges. There have been a number of tenant bankruptcies, particularly over the last few years in the grocery and delicatessen segment, and other fashion retailers are struggling, while certain key tenants remain very, very demanding of the landlords. And this is something that needs to be fully understood. However, prime dominant schemes are really performing well. Stabilized rents and improving turnovers, especially when you go down into the smaller and second tier cities. Many of these schemes are actually outperforming some of the key schemes in the major agglomerations. So that is something to consider. However, there is a unique opportunity to acquire large retail, which is virtually cannot do anywhere else in the region. And we expect around 4 to 5 major shopping centres to trade this year. However, much prime retail beyond this sits with long-term holders. So getting access to or acquiring large city centre shopping centres will become a bit of a challenge in the years to come. So what should investors focus on again? Well, as this happens, focus on dominant schemes in the smaller cities. And when I say smaller cities, it does mean down to the cities of 100,000 but you obviously have to focus on the sort of the industry and the sustainability of their populations as well. Many schemes in these cities create significant upside in terms of the asset management opportunities in these centres that has arisen due to the changing nature of their retail, or some schemes being sort of positioned above what their market could sustain. And in that, there are a number of opportunities. A lot of these regional centres are massively underpriced, in our opinion, because ultimately, while they may have a smaller element of vacancy, the core group of tenants in there are stable. We're now seeing a huge growth in alternative segments of the market, in particular hotels, and my colleagues will talk about this later. But this is due mainly to the rapidly growing volume of tourists into Poland. The recent trades of the Radisson Blu, the Westin, the first trade to a Middle Eastern of a hotel in Warsaw, plus the sale of the Sheraton Krakow last year. This all actually meant that hotel investment was the largest investment sector for the first quarter. And actually hotels having its most active quarter ever in Poland. In addition to that, the new hotel lease operators are going to create new opportunities for investors and a new product. Finally, the growth in demand in the PRS sector, with developers willing to engage in creating product similar to what they have in Germany. And this is in spite of record apartment sales. The residential developers have never had it so good. There was 26,000 apartment sales in Warsaw in 2016, which was the same number as London. But the reason they want it is it enables them to reach their financing hurdles quicker. And certain office developers in the city centre are now focused on residential development, as they can get upwards of 5,000 euros a square metre, depending on what they develop. Conversion is also a potential solution to some of the B-class office buildings. In particular, these B-class office buildings which are structurally vacant, and the creation of micro-apartments in all the buildings. This does not require a change of zoning, and that's an important point. And many developers are keen to promote this. However, most of the residential developers are still at an early stage of even thinking about this, and they've yet to provide answers on some of the key questions. The level of fit-out that would be required, optimum size of apartment, and ultimately potential yield. Particularly outside of Warsaw, Krakow and Wrocław, will it work? Will sales prices be too attractive, particularly in places like Gdańsk or the Tri-City, for developers to even consider PRS? And with the abolition of the MDM program, however, and the changing approach of Generation Y, we are sort of expecting the PRS segment of the market to expand, as certainly the younger people in our office have no interest in owning an apartment. So I think that's the end of the presentation. So I think I just about made it through. If anybody, there will be a panel discussion later and you can ask these questions there, but if anyone had anything to challenge within that presentation, please feel free. Thanks.
Ladies and gentlemen, Sean Attenborough Doyle. Great footage, thank you, Sean. I think we should put some night live footage for all those cities in Poland, also to give you a feel for, how the Poland looks like in a larger scale. Thank you very much. Now we come into hotel market. This is a new sort of sector that CBRE in Poland came into. Marta and Vidi, they will give us a short presentation. How does it look like from Poland perspective, but also wider EMEA perspective? Thank you.
Okay, so welcome dear guests. We have a pleasure today to speak about the hotel market, which we see is significantly increasing in Poland and in CEE. My name is Marta Bratowska-Janiec, and I'm senior consultant at the CBRE Hotels team based in Poland. And today I'm going to present together with my colleague from London office, Viti Dank, who is associate director in the brokerage team. She played a key role by the recent transaction closed by CBRE on behalf of the seller for Sheraton Grand Krakow. So she will be able to share some more feedback from that. Today we are going to speak about the investment opportunities we see on the CEE market with a special reflection to Poland. We are going to touch the topic of operational results we see in hotels, as well as the investment moods we see on the market. And finally, we will come back to the question, why Poland, and what opportunities do we see for you for further investments in our region. Obviously, we don't want to go too much into corporate details, but one thing is crucial here. We would like to highlight that we are 120 dedicated hotel specialists within the European market that specialize directly in the hotel part of the market, in the hotel advisory. So wherever of 16 offices you go to, whether it's Munich, London, or Warsaw, you can make sure we all know each other, and we will try to find you the local expertise within our team. And now we would like to move on to the hotel investment trends, which we see as the new mainstream on the real estate market.
Thank you, Marta. Good morning, all. As Marta mentioned, the hotel sector has become one of the real estate mainstreams. So here we have charts. On the left-hand side, we are looking at investment volumes for totaling in 2007. And then we compare this to, on your right-hand side, the European real estate investment for all asset classes that was deployed in 2016, which is obviously the year that has just closed. And these investments would include offices, retail, industrial, and hotels. And what is interesting to see is that the hotel share has tripled in this period. When we're looking at 2007, the hotel segment accounted for 3% of the total investment volume. And looking at 2016, where it rose to 8%. And it's also interesting to see that the hotel sector is slowly catching up to the industrial sector, which is accounted for 9% in 2016. There's a few reasons of why we see such growth in the hotel sector. First of all, in the recent years, there has been a lack of commercial real estate stock, which pushed the investors to also look at alternative classes, which would include hotels as well. And the second reason is that there has been a greater level of expertise and knowledge in the hotel investment industry, which created a higher level of transparency in the sector, as well as liquidity because of the greater level of transparency. So when we think about the level of liquidity, that helped and boost confidence for investors, especially in the institutionals, where they feel confident that they can invest equally as well as divest of hotels. So because of these three factors, the main factors, we see that hotel transactions has tripled over the period of 2007 to 2016. Now on this side, we look at the amount of capital that has been deployed into hotels across the countries, broken down, as well as we see the year-on-year growth. If this works, yeah. So from this graph, we see that CEE, core and non-core, have received a greater attention from the investment market, with CEE core, which would obviously include Poland, Czech Republic, Romania, and Slovakia, rising to 32%. So a couple of recent transactions that I'd like to touch upon is, first of all, the Varenpex and U-City transaction, which was a 330 million deal that was negotiated in the first quarter of 2017, which is meant to close by the summer of this year. U-City is a Thai investor that has been considering this portfolio. It consisted of 24 hotels across Europe, which included the Vienna House hotel operating platform, of which 5 hotels are located in Poland. The second one, on a single asset basis, you have, Sean touched upon it earlier, the Radisson Blu Centrum in Warsaw, which was sold to Europa Capital for 56 million. And that again was completed in the first quarter of 2017. Just across from the Radisson Blu, you have the Westin Warsaw, that also transacted in the same period, and that was sold to Al Shreya, which is a Middle Eastern investor, and that coincidentally also transacted for 56 million euros. And last but not least, the Sheraton Grand Krakow, CBRE, was involved in the sale of this asset, and that transacted again in very beginning of this year in 2017 for a lot size of 70 million. So throughout this process of the Sheraton Krakow, we have seen very good level of interest, where we were able to drive a very competitive pricing environment, because the buyer, which was a European institutional fund, they really believed in the growth of the market, of the hotel market and performance in Krakow, especially with the BPO services and shared services that is happening within Krakow. And so we can see from these 4 transactions, 4 main transactions, that there is a clear appetite from international investors, ranging from different buyers type, from institutionals to high net worth individuals as well. So on this note, I'd like to hand it to Marta, who will be touching upon the hotel operating performance.
So now we are moving to hotel operating performance, which we know is crucial in terms of driving the value of the asset, because how does the hotel operate, in fact, drives the value of the asset. So let's have a look at how it is presented across different regions of Europe. And we obviously see that Eastern Europe is a rising star. We have the comparison of RevPAR in the year-over-year percentage change, with the result of nearly 13% growth. But here this mysterious question remains, what is RevPAR actually? And I'm sure that most of you who are present on the hotel market know it very well, but we just want to make sure. RevPAR is revenue per available room, which is the key metric which measures the performance of each property and of each hotel. And it's a combination between occupancy and average daily rate, so the price you get when you check in at the reception. So here the expected growth for the next years in Eastern Europe are significant, and we project that they are going to continue. And here we can discuss it in more details. As we see on the graph, we have a problem that demand does not meet supply. Why supply of hotel rooms is so low in comparison to demand? This is driven by the fact that in the last years there was a significant lack of financing of hotel investments. Banks were quite reluctant or felt a bit unsecured, which was driven by the fact that there was a limited number of professional operators present on the market. Now we are speaking about the huge number of professional operators who are coming to Poland saying they want to announce their expansion. They have a number of strong hotels, strong performing hotels all across Europe and all across the world. So this is absolutely a trend to be continued, and we expect that the supply will grow in the next years significantly. When we need to touch the term of demand is quite clear. The tourism is growing globally, and this is transferred also to the Polish market. Poland is becoming more and more popular in terms of tourist stays, and this contributes obviously to the World Heritage cities such as Krakow, for example, which benefits obviously from that fact most, but also Warsaw is becoming a more popular tourism destination for weekend stay, thanks to the also low-cost second airport we have in Warsaw, which is driving the demand. Obviously, the improving economy in Poland also drives the inbound tourism, so domestic tourism is rising significantly. We also have quite a relatively weak euro versus US dollar, so we observe a lot of American guests coming to Europe, and Poland still is very attractive in terms of value for price. And we see that all major KPIs that we have in the hotel market, so occupancy, ADR, and RevPAR, they are growing. The growth of occupancy by 5.5% allows hoteliers to grow the rate, which then relates to the RevPAR, so revenue per available room growth. And on the next slide, we can see how does it look like on a city level. We can transfer it to the city level across Europe. And again, I'm sure we are driving you mad about the hospitality vocabulary we have now, but I just want to make sure that RevPAR is room revenue per available room, whereas TRevPAR is total revenue per available room. And last but not least, the GOP per available room, so gross operating profit per available room. These all parameters bring us to the different areas of P&L, obviously of profit and loss statement of the hotel operation. But the last one, the GOP, drives the significant value of the profitability of the hotel. So we can see here that all those parameters look very well in such cities of Eastern Europe as Warsaw, Budapest, and Bucharest, whereas such major markets as Milan, Paris, or London will not expect this sort of growth in the forthcoming years. In the last quarter of 2016, we did in CBRE Hotels a survey which was about to measure the investment mood for hotel investment across Europe. The survey was very successful because we gathered together 485 answers from respondents, and we decided to continue this survey on a regular annual basis to measure and monitor the investment mood toward hotel investments. We decided to check this because we know that in today's world where geopolitical situation is changing, we wanted to check how does it relate to the hotel investments. And here a lot has been said before by Sean and by Viti, where does the capital originate from? And we see that majority of European investment capital comes from Europe. And this is also transferred to the recent transactions we had of Radisson Blu or of Sheraton. We see that equally 18% relate to Asia Pacific and to America, which then translate back to, for example, transaction of U-City with Varimpex. And last but not least, Middle East capital and African capital translated, for example, to the recent transaction of Westin Hotel to Qatarian Group. So how does this relate to Poland? We see that not only Polish investors are looking to acquire hotels in Poland, but we do see a significant trend in the international investment funds, global groups, looking for acquisitions. This is an interesting slide which says, which answers the question about the this year projections about investments. Our outcome says that investors are either about to invest about the same or more in hotels this year. The only issue which remains is shown under this slides. So for the question, do you plan to invest in hotels? The answer is yes. But do you plan to divest of hotels? No. So there is a lack of stock, and this is a thing that we are facing now. But at the same time, we're speaking about the enormous numbers of hotel developments. So that's what we've spoken before, that there is a limit of supply and limit of hotels to acquire, actually bring us to the good point of hotel developments. And we've been speaking about a number of mixed scheme projects right now, which I will also touch the topic later. The hotel investor market is no longer homogeneous. It means that there are no longer investors who only invest in hotels. We are speaking in agency, we are speaking with all sorts of investors present on different markets as presented on these icons. They come from offices, retail, they build shopping centers, big logistics centers. And it all brings us to the conclusion that there is a significant trend toward mixed-use schemes in Poland. This is also because of the lack of the land we have, about the idea of diversification of portfolio in terms of reduction of the risk. And this is something we've been discussing recently very often. Obviously, we are speaking a lot with institutional investors. They are looking for similar operational forms, such they know from office market, for example, so leases. And we have a number of operators who are willing to offer lease agreements in hotels. So this also brings us some opportunities. Here we should also consider that in the time the market is changing, we see that there are a lot of B-class, C-class office buildings in Warsaw, which are about to convert. So we have a couple of opportunities for asset managers to actually transfer their current buildings into the hotel properties that are located very well. And we see that this trend is going to continue. What are the locations for capital of the investors? Globally, Europe-wide, we see that the core funds are looking for capital cities and gateway cities, whereas more opportunistic funds are looking on the secondary cities and leisure type of resorts. In Poland, I need to say that we have so many opportunities in the main key economic cities in Poland still, that all sorts of funds are looking in the first phase on the biggest capital gateway cities. Obviously here, Warsaw is the key market, which is the strongest economic market in Poland, becoming a capital of CEE right now, but also Krakow, because of its heritage and a very strong leisure type of tourism, is becoming a very important player. We see a significant trend toward the new pipeline of hotels in such cities as Gdańsk, Łódź, Katowice, Wrocław, and Poznań. And there is where opportunities for the developments are. And last but not least, the topic which I touched a bit before, a new trend on the market in Poland toward lease agreements in hotels. This is mainly due to the fact that there is unsecure time in the history right now, and all institutional players are looking for a secure cash flows and secure returns. So we've been speaking now with a number of operators who do offer lease agreements for hotel operations. Franchise agreements and management agreements offer obviously a little bit more flexibility. So it really depends on what type of project do you want to develop. In the regions which are very well established, it also makes a lot of sense to go into this kind of scenario. We observe that in a lot of cases, developers want to go into forward purchase scenarios, so they want to sell the property even before it starts operating. In this case, the lease agreement is something to be considered. And now we are arriving with the last question, which is crucial today. So why Poland? What are the opportunities? And so Viti, can you share your perspective on that?
Sure. Thank you, Marta. Why Poland? It was interesting from the intention surveys that we did not too long ago that Poland came out to be one of the top 10 hotel investment market that investor would be looking at, and it's also the only CE market that made it to the top 10. And I think if you're looking at Poland, the main drivers are the stable and healthy economy with good growth ahead that is also sustainable. And also the strong tourism development is also being pushed, which it will feed into the strong hotel performances across Poland. And so this will ultimately drive the capital values for hotels. And so when we think about returns, investors seeking higher returns will look at markets in the CEE or in Poland because there is actually less competition than other markets such as Germany or the UK, where you see higher and tighter, I should say, yield compressions. So this is why mainly I think investors would look at Poland. I think the question back to you, Marta, is where do you see the opportunities and what are the opportunities really for Poland?
I think this is what the whole presentation brought us to. So the moment that we finally see that the expected growth performance is to be continued, and this is not only in Poland, but in the whole CEE region, and the strong investment mood for hotels now drives the pricing. So if you're looking for the opportunities, you should definitely look at the CEE, because this is a region where you won't face the same yield compression. And we will be happy to help. So we invite you for a break. We thank you very much for your attention. And if you have any further questions, we are here to answer that. Have a good day. Thank you.
Marta, Vidi, thank you very much. Ladies and gentlemen, now we have a coffee break, which will take approximately 45 minutes. It's longer than expected, but you will be able to share the knowledge between you. And we start sharp at 12 with Paweł Dębowski. Thank you. Ladies and gentlemen, let's go back to the tables. Hello. And right after Yola, there'll be a panel discussion, then lunch. And big round of applause for Yola.
I can assume that you can be very disappointed that Paweł is not present, but unfortunately, I was told by our organizer that Paweł is very busy, that's why he cannot come. Of course, I cannot tell you that I can substitute Paweł, but I hope that I will say something what might be interesting and you can find it interesting from the legal perspective. What we can observe on the market. You perfectly know that starting from the last quarter of 2016, we faced a lot of difficulties in respect of the classification of the transaction from the tax perspective, the challenging asset deals on the market. Immediately, all of the investors started to think how to swallow this problem, how to deal with this problem. That's why we can observe a lot of enterprise transactions which have been completed during last quarter of 2016 or due to these difficulties connected with the recovery of the VAT. Some of the transactions have been postponed to the first quarter or even to the half year of 2017. What we have developed together with the sellers and the purchaser, how to mitigate the risk related to VAT or CLAT to be paid. That's why the understanding, the side letters are signed between the parties. And within this arrangement, the parties are trying to split the risk between both of the parties. Of course, it is completely a different perspective in respect of the risk from the seller perspective and from the purchaser perspective in respect of the asset deal. Much more risk is on the purchaser's shoulders in respect of the enterprise risk. Bigger risk is on the seller side. That's why, from my perspective, I can say that we spent a lot of time together with our clients to negotiate this understanding or side letters to mitigate the risk. I think that now it is quite stable practice on the market. That's why everybody are aware how it is to be drafted, how to secure the position of both parties. It is not a perfect solution. However, it is some kind of remedy and the reaction of the market on this difficult situation. As it is mentioned a few times during the presentation, now the situation is much more better on the market. There are a lot of signals that VAT has been returned to the investors. That's why we can expect that we will not face any more challenges on the structures of the transactions, and this market will come back to the situation when we can say that it is really a stable market from this tax perspective. What we can see more? We see more and more investors looking on the Polish market. It is not only logistic, which comes first to my mind when I see Robert, but it is retail and it is office as well. We can see some Asian money which would like to be invest on Polish market, maybe not directly from Asia, but using European platforms and being backed or with some joint venture with the existing investors. Market seems to be promising from the amount of money being on the market, from the interest already expressed from different parts of the world and from the investors. We know that they are a close group of big investors which have been on the market, which are on the market, and hopefully they will be in the near future on the market, but some newcomers are visible on the Polish market. It's good because there is some new wave on the market, some new look on how to do business in Poland, and it increases the position of Poland within CEE and within Europe. As lawyers, we have a lot of hopes together with our clients in respect of the Brexit, because we believe that some clients will decide to move their business from UK to Central Eastern Europe, and then we believe that if this decision is made, Poland will be a first choice. That's why after first quarter of 2017, from the legal perspective, I cannot say that we are extremely optimistic, but we are pretty optimistic, and we fully believe that we will be able to find a solution and mitigate any risk you may face as the investors. Thank you.
Jola, thank you very much for this unexpected but very comprehensive perspective, lawyer's perspective. And now we're moving to panel. Can I invite to the stage Jeroen van den Tulen, Ghelamco. Jeroen, who are you? Yes, you are there. Matthias Brodesser, Head of Transaction Management, Warburg HIH. Liad Barzilai, CEO, Atrium. Anton Selman, Head of CE Investment, CBRE, and Robert Dobrzycki, CEO, Europe Panattoni. As promised, I will grill them, but not sure whether you guys need some more of introduction, but maybe very short from your perspective, what you do, what's your roles in the business. Anthony?
Anthony Selman. I'm in charge of investment properties for CBRE in Central and Eastern Europe, the Balkans and the Baltics. So I oversee some 55 brokers, about 100 transactions a year. So we have a good view on the macro perspective in the region. Thank you for having me.
Liad Barzilai, Atrium European Real Estate, retail player, focused only on Central and Eastern Europe. We have 60 assets, over 1.1 million square meters of lettable area.
Robert Dobrzycki, Panattoni Europe. Panattoni is a logistic development company. I'm overlooking for Panattoni European business.
Hello everyone, I'm Matthias Brodesser from Warburg HIH from Hamburg. We are rather a newcomer to the market, so thank you very much for the invitation for the panel, that's flattering. Warburg HIH is a pan-European investment and asset managers with roughly 15 billion euros under management. I'm heading the international business, and CEE markets at the moment, being a pan-European investor, has a certain focus for us.
My name is Jeroen van het Oler. I'm the managing director for Galamco in Central and Eastern Europe, which is actually mainly Poland for us and a little bit of Russia and in the past Ukraine. But we are mainly developing offices. In Poland we have done over 800,000 square meters, and in Russia we are doing logistics.
And big congratulations for the MIPIM award. Warsaw Spire was awarded. It's big thing not only for Galamco but also for Warsaw and the whole Poland. So big round of applause for Jeroen.
Thank you.
Guys, so different perspectives, different asset classes, but let's first start from Anthony. Anthony, you're overseeing the CE investment team. You're speaking to a lot of clients from different geographies. What could you tell us? What could you say? How could you estimate the current sentiments for Poland from investors' perspective, and CE, of course?
I'll be brief because I think the guys next to me know even better and have a different insight, but I think it's basically what Sean said earlier. Poland's resilient for us now. We see core money buying again, which is very encouraging. I think the big story for us over the last year into the first quarter of this year has really been the Czech Republic as well, transacting 4 billion in the last 12 months, which is basically a volume that you would expect for Poland. So Czech is booming. Poland will continue to boom. Hungary, very, very positive right now as well. And we see slowly this going to the region. So we see Slovakia will probably be becoming the next big story after this. But so we see, I think the core markets continue to outperform, continue to boom. That's what we see.
Yeah. Liad, maybe you would like to share your view on that topic.
I think from our perspective, the Polish market, of course, there's a lot of supply now coming to the market, big products. I think in my personal view, there's sort of a discrepancy between pricing and where people think their assets are, so how they see these assets being very prime and very strong, and where they want pricing and where these assets really are, considering the competition, the saturation of the market, and the challenges that retail is facing in general. Of course, we've heard it before, there's so much money around coming into play, so there's a sort of a pocket for everybody. So I think the market will still continue to perform well.
So positive.
Poland positive.
Okay. Matthias, you are saying that you see from a pan-European perspective. So what do you discuss internally, looking at Poland and CE?
If we discuss internally, we discuss a lot about politics. So my disclaimer, first of all, is that my team and I, we love Poland. So whenever I do make reference to politics or being typical German, a little bit half-glass empty mentality, that is not meant in a bad sense. However, at the moment, if we discuss in investment committee with reference to Poland, we still discuss politics. It has diluted a little bit. Obviously, in 2016, it was all over the press in Germany. It has been diluted by other political crises, I would say, whether it's Brexit or Trump. So we do simply what we can do best. We're trying to do our business, but nonetheless, you have to discuss politics. We always took the stance with regard to Poland that this is a general political system. It's one term. It will be fine. On the long run, we are bullish on the sixth largest economy, obviously, in Europe. It's a growth market for us. That's why we like Poland. However, then what Jola has outlined, there was an impact on real estate with regard to the VAT issue. That seems to be solved. However, at the moment, it leaves at least a bitter taste. Even though it may be solved, you don't know what will be on future transactions. So that being said, at the moment, in the ongoing transactions, we still entertain enterprise deal just to keep at least a financial buffer if that situation comes up again. But generally, the sentiment is positive. However, you discuss, as we have seen also in the presentation, the development pipeline in Warsaw. So that remains like also a concern. With regard to Czech market, it's a rather smaller market, but it has performed very, very well. For us there, we are positive sentiment-wise, but there is a lack of products we can buy. And finally, Hungary, which is the other market which we always try to look at. Again, not to get too much political here, it has great fundamentals in our view. Vacancy rate is low. There is an increasing trend of increasing rents. However, that being said, again, we were slightly discussing Viktor Orban as a person and his politics, unfortunately, with regard to Hungary. So my board was quite downbeat on that one. Now we can see other investment managers investing German money. So this is coming so there are some front runners. And we think, again, having a lot of political crisis that will dilute a little bit here. And we see that this will be an increasing market over 2017.
So in general, positive?
In general, a neutral with a notch towards a positive sentiment.
Okay. Jeroen, you provide product to the market as well, Robert. So Jeroen, maybe first, what's your view on the investor sentiment? You're constructing a lot at the moment, so I think your view is positive. Is it?
Yes, what we have, I think, it's a bit linked to what is stated before. What we have seen, say, in the middle of next year, that we are actually during the course of next year, first we had the Polish government being very nice towards Brussels. Then we had, Brexit. Then, we had the next thing coming, which was Trump. So we saw that, last year there is, over 4 billion done in Poland. But we saw that there was a bit of slowdown in the decisions for large properties, yes? So, the smaller properties went, but there was a bit, hesitation. And I don't know exactly what has happened, but, from after Christmas, from January, February on, it's like a lot of interest, and it looks like all these, things from last year are all forgotten and all accepted. So, we have a very good interest, and now, funds are, actively calling if we already can pre-sell product. And in the next 18 months, we will sell projects of a total value of around 750 million euros. So like larger and smaller projects. And, we are very positive at the moment. And also looking at the tenant demand, which is there, we have decided, to continue the development pipeline as, we were predicting before. So for us, we cannot complain.
As usual. Robert, how about you?
Yeah, obviously, from a logistic perspective, the main theme which we see, which is very exciting for us and for the market, is obviously e-commerce. And 30-40% of our volume, euro volume, is kind of coming from e-commerce. So these are big boxes, big leases, long leases, and generally, so far, just serving Western Europe. This is kind of a completely new, kind of a new absorption which is coming to the market, making the vacancy rate close to 6%. So e-commerce is completely changing the dynamics, and the volumes which we produce right now are historically high because of e-commerce. So it's going to continue, and we are working on the new deals based on e-commerce. Usually we are pre-selling the investments. They are long-leased long list deals. So we feel like a very exciting time right now for us. Obviously, political situation doesn't help, but I mean, labor cost plus flexibility of the labor code plus proximity to Germany and e-commerce theme are putting a lot of pressure demand-wise on logistics, and it's going to continue. So it's a very exciting sector.
But who do we compete with from your perspective? You said, you know, labor costs, e-commerce that drives the market, but what are the other markets which you know, consider a strong competition from your perspective?
Clearly, Czech Republic, location-wise, is probably better located than Poland. The problem with Czech Republic is obviously small, and availability of land is not there for big boxes. So you can't produce a big box there. That's one second thing. The third thing is availability of labor. There is no labor in Czech Republic. So Poland has much better dynamic from a labor standpoint. And in each kind of a e-commerce shed, there is working 3,000 people, and before Christmas, there is 5,000. So you have to have labor. Czech Republic is obviously a great location, but labor-wise, it's much behind Poland. So I think Poland, from that perspective, probably is one of the best markets in Europe, and demand-wise, take-up-wise, it's number 3 in Europe, behind Germany and UK.
Thank you. Interesting perspective, and I like that. I hope you know, not everyone from Poland will leave somehow when the borders. Actually, Ukrainians. There's a threat that Ukrainians will go to Germany when the borders are for them open. But so far, so good. I understand. Liat. Question to you. Where do you think is the future source of capital for real estate investment? Where this money comes from, which will be invested in Poland?
Well, we heard Jos before, so saying the money is coming from the east, going back from the US. Quite hard to predict. I think as long as the interest rates stay sort of low, money will keep coming in. Quite hard to say where it's coming from, because each day you hear of a new investor, of a new source of capital, we have an example here on stage, you know, coming into the market. So quite difficult to predict.
But you confirm China, Malaysian money?
Definitely.
USA?
Yeah, definitely.
Okay. Anthony, your view on that? What do you think?
I was just going to add South Africa obviously is a big source of capital for us.
Still.
I think one comment to make perhaps about South Africans is that I think we've seen a split now. They came in 2-3 years ago, bought aggressively in SEE, bought aggressively in Poland, own very significant positions in Poland now. And I think I see a split now where originally when South African capital came in, which was driven by currency risk at home, REITs that were not performing as well because of that currency risk, they came in for the 7% type of returns. Now I think we see really core returns where they're competing with German money, traditional sources, and we see them going farther east, looking for the more opportunistic returns. So I think there has been like a division of those capital streams, and we see it now in Romania, we see it in Slovakia, and I expect we will be seeing it in Russia even in the next year and a half.
All right. There's a hot topic in the market in Poland. It's REIT legislation. What is your view on that? Is it a solution required for this market? Maybe let's start from Jeroen.
I think it's very good for the market. So because at the moment there's like a little bit of gap, because there are a lot of investors for like, you know, AAA class projects from all over the world. Yes, I think there, of course, historically we saw a lot from Germany, from US and Austria, but now we see also a lot of Asian money coming into the country. But you know, there are very good, I would say, secondary products available, as well as in Warsaw, as well as in the regional cities, in the, say, top 5, 6 largest, biggest cities in Poland. And in these markets, it's difficult to sell, yes, or more difficult to sell, let's call it like that. So, because when you talk to the, you know, the institutional investment funds, they say it's very difficult for me to sell Rzeszów, yes. Well, maybe, you know, 10-year lease agreement with a very good covenant and looking at it, it's maybe a very good investment. So I think when there are the, you know, the REITs which more look at, say, different type of products in Poland, it will be good for the entire market, and the returns for these funds will be very good as well. So yes, for the total market, I think it will be very good when this is coming finally into play.
I would like to say something about REITs.
Just one comment. In the Czech Republic, we just looked at this again over the last week. The volume of domestic capital, I think it was 32% last year, of all acquisitions of the whole market. In the first quarter of 2017, it was almost 40%. If you compare it to Poland, it's probably more like 5%. So I think there's tremendous value to be unlocked still here, and the REITs will make that happen. I think that's also the reason that Czech is so competitive right now with Poland. There's just a lot of capital here that's not able to buy yet. And once it opens up, I think you will see a significant increase in volume in Poland as well.
Okay, so you strongly believe that this will help the market and we should push forward this legislation. Matthias?
Yeah, personally, I think it will add professionality to the market generally, and you will open up the market to more international investors, even more international investors. Also, I hope that there is a growing Polish community who is using private as much as institutionals to use such vehicle to invest in. However, I would not only bet on the Polish REIT. For instance, the German REIT was introduced in 2007. To date, there are only 3 companies who have subdued themselves, despite all the, at first sight, positive elements attached to them. There's threefold or fourfold of companies which are quoted, which have not decided to subdue themselves to the REIT status. So that's at least you want to bear in mind. I think there were 2 elements to it. First of all, there is obviously a wall of money all around the world, but that wall of money is chasing bricks and mortar. If you wrap a quoted company around bricks and mortar, then you subdue yourself to capital markets. So you then have not only the alpha from your cash-on-cash return, you also have the beta, the volatility of the market. So easily we have seen REITs which have a volatility of 10% over a year. You just want to factor that in. What is the market, the peer group seeking when they do real estate investments? And result of that, what I would, I'm not in a position to give any advice to the government or whoever is working on that project. For instance, in the US, you have private REITs, so you have all the advantages of a REIT, but you will not have the disadvantages being quoted or floated on a stock exchange. In Germany, it is a prerequisite. And personally, I would strongly argue that you should introduce private REITs, because then you would get at least rid of the volatility being quoted on the stock market. But generally, I think it will be a good addition to the Polish market.
All right. Are there any, from your experience, are there any other solutions, tools which could be used to, attract the market, make it more liquid? Is there any like a magic advice on that, Liat?
Magic advice, no. Not, at least I don't have it. If you have it, happy to hear. I would just comment on the REIT structure. I think it's a great thing. It will allow to open really the Polish people to invest in real estate long term. I agree with the volatility issue, but if you want to invest into real estate and you don't have the capital to do it, this is really the way to be there and to get sort of the yield on an ongoing basis. And I think it's a great source of capital. But magic ideas and magic solutions, that's, we're bricks and mortar. I don't have them.
Time and hard work.
Also, I would focus of introducing one. I compared that the older in the room will know when we had video cassettes. You had so many different systems, you didn't know which one to buy. So that's also, I think, in Germany, part of this, that the story didn't function because you have the open-ended funds. So you had already a kind of a liquid structure where you, as a private individual, you can put your money, and you had the flexibility to withdraw the money. So I think there was competing systems. So the more, obviously, you have as a competition where you want to put your money, the less the individual system may succeed as a standard.
All right, so, but we're talking that, in general is a positive, but what are the challenges? Robert, what are the challenges in your area?
Yeah, clearly a political situation around Europe and globally and in Poland is, especially in the short run, is not helpful. The issues with VAT are creating short-term kind of liquidity issues and not helping the normal market functioning. So this is not definitely helpful. But fundamentally, feels like a great, strong story. But there will be short-term bumps, and political issues are one of them. So that's what I can kind of see right now. On the liquidity issue also, obviously, lack of local capital in Poland, as we discussed. So, I mean, REIT would help to kind of deepen the local kind of a capital, but also local management. Because on top of kind of a capital, what would be helpful is to have kind of a sophisticated local management and sophisticated local kind of acquisition know-how, which would help with underwriting locations, which will help underwriting specifications, underwriting rents. That all would help liquidity. And so far it's missing. It's starting to show up in Czech Republic. Maybe easier on a smaller scale, maybe a bit more local capital, I don't know, but it's missing in Poland, and the establishment of REITs would definitely help. But lack of local capital, if the local capital shows, obviously, as Matthias said, it would open Poland for international capital even more.
And Liad, on the retail side, what are the challenges you're facing?
Well, obviously we're facing the online challenge. I think retail in itself is going through tremendous change. You hear day and night articles from the US about Macy's and the sorts of the closing down. But I think every market has its own specifications, so I would not panic and think of that. I think retail is going to go through a change. You're going to see, at least in our view, or a differentiation between the top products, the prime products, where people will continue to come shop, continue to spend time. These will be places where people spend more and more time, and they will be more intriguing with more food and beverages and all of these themes and concepts. And on the other side of the scale, you're going to see the smaller community centers that really serve the daily necessities. And these two elements, I think, are going to be differentiated. And everything in between is going to face the digital or the technological revolution that I think we're facing. Is it by the online sales, by the automatic cars, or whatever you can think of. So I think those are the two places we're going, and everything in between is really going to change.
Jeroen, what is your challenge in your daily operations when you plan your business ahead?
To get permissions for construction, dealing with the authorities.
But it's not that bad like in Prague, for instance.
Now, I don't know about the Prague market, but I can say that because of the governmental changes in Poland, and when the national government and the city government is not the same party and they are in big fights, everything is delayed and delayed and delayed and delayed. So nobody wants to take decisions. And in Warsaw, a lot of people from the administration have been fired, so all new people. So, you know, there is like big delay in processes of getting the permissions in place, I would say. This is our biggest problem at the moment in the
is
development.
It like back 2004 when we had also very like a stop for investments in Warsaw? Is it the same situation like it was a couple 13 years ago?
The thing is, there is a willingness, yes, but when you look outside of Warsaw in other cities, then I would say it's much easier. Yes, on one hand, maybe it's good because everything gets delayed. At the moment, you can see that around, you know, the area of Rondo Rasinskiego, there is almost no space available because the buildings which are coming to the market are fully leased. Yes, the new building we bring to the market, the building Skanska brings to the market, they're both leased. Only the building Heinz brings to the market, there is some space available. So the entire, you know, rest of this year, rest of next year, till the middle of 2019, there will be no delivery of buildings over there. So, and then from, you know, end of 2019, there will be coming the new projects. And I would say from the leasing point of view, say we are missing a lot of opportunities at the moment. But on the other hand, you know, tenants are therefore having to look much further ahead and start to secure space. So we are much earlier in the process leasing space than it was in the past when tenants were waiting, say, 12, 18 months before the completion of the buildings to really sign agreements. But, you know, to sell the projects is not the problem. To get the financing for the projects at the moment is not a problem. Equity is there enough. To sell the bonds is also relatively easy, I would say, today. So, and I think, you know, the same as what was the discussion in the logistics market, the same, say, positive thing about the digitalization we see in the office market, because we talk about Brexit, but the whole trend started before the discussion of Brexit, and Brexit is only used as an excuse to accelerate processes which already were planned. Let's call it like that. And everybody, and I'm really surprised when I see the reports about where the companies go to, and it's about Frankfurt, it's about Paris, it's about whatever, or maybe a little bit to Amsterdam. But what is, I think, really happening is that they are putting in maybe, you know, the higher functions to these cities, but in number of people, it's relatively small. And the big
Back
chunk,
office, yeah.
yeah, for office, yes, but the big number of people is ending up, you know, in Poland or in Lisbon and in some other locations as well, which is good for the office market because we haven't seen organizations coming from zero, taking 5,000, 10,000, 20,000, 25,000 square meters from nothing. So it's good for the economy as well because it brings a lot of, say, new people to the big cities because they are sourcing everywhere the employees. So, you know, we see like totally new processes and there's new demand for different quality of office space, yes? So, you know, we are trying to, you know, to be part of this process.
And what is the longest permitting process you observed in your case?
10 years.
But it's extreme, but on general...
It's now under construction after 10 years on Vauxhall to Kamenitsa.
Yeah. Robert, your perspective on permitting, how in your space, how does it work?
Obviously, inner city, last mile logistics, that's very tough permitting-wise because it creates a lot of traffic, not a lot of jobs. But on top of it, I don't think there is a big issue. There was new legislation about agricultural land recently implemented in Poland, which kind of limited a bit of supply of new land. So that's a bit of challenge. But overall, I don't think in the places where we build, the permitting is not the main issue. In inner city, obviously, it is.
And Liat, from your perspective, you're making extensions of your centers. How does it look like?
It's not easy. It takes time and it's complicated, and all these changes and political changes are not helping either. You know? So yeah, it's definitely in the inner city a complicated process and time.
But complicated, but manageable. It's not like, you know, nothing is happening.
Slowly.
All right. Okay. We're talking a lot about offices, about logistics, retail, but how about alternative sectors, Marius? Healthcare, residential, student houses, hotels. Do you talk about those investments in your boardrooms?
Generally, on a pan-European perspective, we discuss all of them in different or various stages or depth. When it comes to Poland, personally, and grateful for the lecture we had earlier, I'm pretty keen for the hotel market, also for the rest of CEE, especially Prague. It's simply the nature of having long-term secure cash flows, so this clearly is flavor of the years, I should say, for institutional investors. Foreseeable cash flows ideally stemming from a lease agreement, not so much from a management agreement. So I was concerned a little bit of the numbers I've seen in your intention survey. So we will look at that, especially in Warsaw and other cities. You have great numbers of tourists, and also like Krakow, for instance, great number of tourists, but also expats working for the BPO sector. So there's big time possibilities there in my viewpoint. For the other asset classes, I think this is also interesting to invest in there, like student housing or private rental sector, which is a mega trend. You mentioned, or John mentioned, Generation Y, rather want to lease than to own. However, from our perspective is that this income most likely will be in zloty. And if you have zloty income, you have zloty financing. Zloty financing is more expensive than euro financing. And that's a personal requisite, we have to hedge these positions. So if you would factor this all in below the line, we have a much lesser return than we would have from a euro lease on a hotel, for instance. So in our, from strategy-wise for Poland, would be a big-time focus on hotels, but not so much on the other asset classes, but for personal reasons, so to speak.
And Liat, do you discuss any alternative classes or just retail?
We're just retail, but as I mentioned earlier, I think placemaking and city placemaking is going to be a big thing. The millennials coming into play, into the workforce, the way they live, is also going to come into play. So a lot of these mixed-use combinations and these locations have to come, and there are going to be alternative uses. It's not going to be us investing in those things, but I think there's going to be a lot more interesting things.
Okay, Anthony, and your perspective, different asset classes?
We see residential interest in Russia always. It's always been very resilient in Russia. I think we have a lot of questions from investors now in Poland and in Czech. We just don't have the product, so we're working hard on unlocking that product. Alternative for hotels, I think it's across the capitals in CE. Very strong interest, just not enough product either. Yeah.
So it's just a matter of time that this, will kick in.
For a residential, matter of time, yeah, it's starting to happen. And for hotels, we just need more hotels. Yeah.
Okay. Guys, and the last question, because we need to foresee the future somehow. 2016 was, despite the political environment and different challenges, it was quite a good year, 4.7 billion of investments. What should be the number for 2017 if you look at the current market conditions? Who is, so brave to say?
As an agent, I would answer. I think if I look at CE now, and we track this almost daily. Now we do like 100 transactions a year. I think we're up literally 25% from last year. It's because our brokers are really good and getting better every year, but it's also because of the market. So I would say 25% up is actually feasible. Poland had a little bit of a hiccup now, but I think the guys on the panel here can confirm it's back. So I would say 25% over the 4.7. Yeah.
Okay. Anybody dares to answer the question? But you guys investing, so the volume should be okay.
Yeah, I think sentiment-wise, we should come to that number, maybe exceed that number. The question is, and again, I don't have the full picture, I could imagine that there is a lack of product because there's great buildings coming up for the at least core community to invest in, but they're at the moment lacking the occupancy you want to have. So the question is whether these come through this year or next year. Also, if you like to do forward fundings, forward commitments, what we personally like in order to enhance our returns. So we theoretically could buy now into this building, but with, again, having the uncertainty on the VAT issue, again, not getting too political here, is the longer your period, your gap between signing and closing is, obviously, the more uncertainty is there, what at the very end you end up cost-wise and structure-wise with. And as always, uncertainty is poison. So that may dent a little bit, so a mixture of whether there's enough available product to invest in the combination of what will happen to political situation over the course of the next month.
All right, I think we're done. Thank you very much, guys, for sharing this, your perspectives, opinion about the market. We're about to close. There's one thing in our agenda is lunch, which will be served on a first floor downtown restaurant, and I hope we see each other tonight at Sika Awards. From my perspective, I congratulate everyone who is going to be awarded tonight. And also, please join us at the virtual reality, CBRE virtual reality stand at Sika. Thank you very much for attending.